planning overall is very important. And really, it should be a year-long effort of optimal planning, but
What is it going to cost you in retirement to live a life that you're currently living or even better?
As we approach Thanksgiving and the holiday season, it's very important to take a look at your financial situation. I'm your host, Andrew Brill. If you need help being financially resilient, head over to wealthion.com/free for a free, no obligation portfolio review. We'll talk about end of year strategies to maximize your wealth and minimize your tax bill right now. I'd like to welcome back Brett Rentmeester and Brandy Maben of our partner RIA WindRock. Brett is the founder and managing director, and Brandy is a director of WindRock. Brett and Brandy, welcome back. I usually get to talk to you guys one-on-one, so today it's a treat for me to get to talk to both of you at once. How are you guys doing?
great. Thank you, Andrew.
Doing really well. Thanks for having us again.
Absolutely. Now, this is the time of year when we start thinking about the end of the year stuff. I know we're getting into Thanksgiving and there's end of year planning that has to go on. And a lot of people are like, I'll put that off. And then it gets to be too late. How important is end of the year planning when it comes to taxes and finance and setting up yourself to try and bring down that income a little bit?
Yeah, I mean, I kick that off, Andrew, by saying planning overall is very important. And really, it should be a year-long effort of optimal planning. But in reality, what happens for most people is they get to this time of the year and it's, feels like you have all this time between, say, Thanksgiving and the end of the year. But as we all know, it's a mad rush. And you start getting together with family at holidays and talking about investment markets, tax stuff. And there's kind of this panic of, my gosh, I got to get this done before year end. I wanted to do this, wanted to do that. So I think, it's critical if you're going to do it to start thinking about it right now when there's still this window of time, ahead of us.
How big of a surprise can it be if you don't plan? I know for, personal story, I went to buy a house and my financial person, we'll sell all this stock. And they didn't do it right. So how surprised can you get? I got surprised with a pretty big tax bill. So if you're not thinking about this, how big of a surprise can you find?
Yeah, well, listen, from a tax perspective, you can be very surprised, right? Like your situation. And I think really your question comes down to kind of a fundamental point of planning. And that is really you need a team of advisors around you that are helping you stay abreast of the changes in law and up to date on all of your planning. And that would generally be an investment advisor, a good CPA, and an estate planning attorney or some other legal counsel. So if you have a good team in place and it's actually a team of people that talk and collaborate, then nothing should really be a surprise. But to your point, Andrew, a lot of times we find people with a big surprise. So today we're hoping to walk through some critical kind of core areas to think about for everybody in year-end planning, and really across four major categories: tax, gifting, retirement planning, and benefits.
So, Brandy, I know this is your area of expertise, and you counsel people on this. And we've had discussions about getting the right team around you. But let's just, for argument's sake, we've got the right team. What are some of those strategies for optimizing how little taxes we could pay?
Right. Yeah, that's first on our list. And we're going to go over a couple on this podcast, but keep in mind, we have a little bit more detailed list in an article that you can also click on. So the four areas I would say would be some income timing deferrals, tax loss harvesting, RMDs, and qualified charitable distributions. And a little bit about each of those tax strategies would be going back to income timing and deferrals. Some business owners especially really try to give their employees incentives or bonuses at the end of the year. Well, it might be fortuitous of them to do so January 1st if they didn't have a very profitable year. An employee, if they had a lot of commissions and they want to go to their employer and say, is there any chance I could defer my bonus that you plan on giving me until the beginning of January of next year? That could help their taxes as well. The next topic was tax loss harvesting. This is a strategy of selling investments with unrealized losses to offset capital gains. Just make sure on this that you think and you go through with an advisor, but a lot of people are investing on their own. Just avoid the wash sale rule. So if you are offsetting these capital gains, let's say in an S&P 500 ETF such as VOO, you want to get tax loss savings and you sell VOO. You can still optimize and maintain exposure in the S&P 500 through a different ETF like IVV within that wash sale time frame, which is 30 days. So a wash sale rule you cannot get from VOO back into VOO. But you could go VOO IVV and tax harvest those losses. The next topic was RMDs. So if you are 73 or above right now, you want to make sure with your advisor or your custodian or your CPA that you're making sure that calculation is correct and you've taken all that you are required to take at the end of the year. RMD stands for required minimum distribution, and those happens in any qualified retirement account that has been deferred tax benefits throughout your life. Now, with that, if you don't take it, you're going to get a 50% penalty on the money you don't take out. So let's say you have $1 million IRA. That will calculate roughly around $40,000 to take either in a lump sum or throughout the year to cover your RMD. If you didn't take that and January 1st hits, you'll be penalized 50% or $20,000 on that $40,000 you were supposed to take out. Go ahead. Yeah, it looks like you have a question.
What happens if you've said, okay, you know what, I'm going to take that $40,000 over 12 months, but you only get to $38,000. You've taken 38. You still have two that you can you make a withdrawal of that 2,000 before December 31st? But if you don't, do you get penalized the 20,000 or do you just get penalized on the 2,000 that's left?
That's a good question. So it's only what you have not taken out. The penalty of 50% would only cover whatever minimum distribution you missed. So it would be $1,000 in that $2,000 example you just gave.
Are you concerned about your financial future or think your investments could be doing better? I'm Andrew Brill, one of the hosts here on Wealthion, and I've been there. Not sure my money was in the right places. It's why I've gotten help from a financial advisor. Maybe it's time you think more about your financial future or get a second opinion about your investments. We've made that process easy. Simply go to wealthion.com/free to speak with one of Wealthion's registered investment advisors for a free, no obligation portfolio review. Again, that's wealthion.com/free. I'm now less anxious and confident I can achieve the financial goals I've set for me and my family. All right, so all these things that you're talking about are trying to lower our adjusted gross income. Is that some of those things that we're trying to and that's what a lot of your taxes taxed on?
Yeah, a lot of it is. Now, it just depends on the tax bracket you're in, the income level, the high net worth versus low net worth strategies you're in. If you're having a low tax year, low income year, your strategies are going to be a lot different, like trying to convert some of your deferred accounts into a Roth IRA, for example. If you're having a low income year, that's a great strategy to think about. But if you're a high income earner, you're trying to think of tax loss harvesting and income timing. So it all depends on your situation. And going back to Brett's point, making sure you have that team in place behind you to advise you on your current annual strategy would be best.
So WindRock has a team of people. Not only you deal with people's finances, but you can actually also recommend teams of people that will help in that realm, right?
Always, yeah. We have a lot of trusted advisors around our team that we can counsel our clients to go to, but a lot of clients come in with their own preferences. And if that happens, we are really great at being the quarterback of these teams and making sure we're all getting on the same page, whether it's phone calls, Zooms, emails. We're in constant communication for the betterment of our client.
So where do, I know that charitable distributions are on that list. Where does that come in when you're talking about this stuff?
Right. It comes into play mainly with our high net worth clients or people that have a lot of income in one year. And there's two areas to this: charitable gifting and then family gifting. So charitable gifting, we look at certain areas like, well, how much did you give last year in 2023? Let's plan on maybe gifting right now to an account that and we like to use donor advised funds. Let's gift a lump sum to that now to strategize for your 2004 obligations that your CPA could help estimate for us. One of the strategies we use to fund a donor advised fund are gifting appreciated stocks, let's say. If you have a huge growth in the S&P 500, we can actually sell that stock to a donor advised fund, or even not the fund. If you have a charity of preference, you can give the stock to that charity, and then you get the tax write-off for the sale of that stock and not have to incur any capital gains. Another way we do is we try to front load charitable gifts, front load these donor advised funds so that in those high tax years, you're really strategizing well. And then family gifting. Brett works with this a lot, especially with our family office sector and our high net worth sector. So he can cover a couple of those areas too.
Let me just add, if I could, Andrew, on the just charitable gifting, echoing what Brandy said. A lot of people don't realize they can gift appreciated stock. So we've had situations, of course, where people gift stock that they've had for 20 years. And again, you get the full deduction without ever having to pay that embedded tax. But we've also gifted Bitcoin. You can gift any highly appreciated asset. So I think it's a pretty powerful gifting tool that people should be aware of. And again, as Brandy said, when you start front loading gifting, if you have a big income year or you sell a business, then you're trying to park more away to at least get the charitable deduction. It doesn't mean you have to give it away to specific charities that year. Doing these donor advised funds or even a family foundation, which is similar, but for maybe a larger donation, allows you to get a deduction, park the money away, and then over the next, remainder of your lifetime, choose the charities you want to gift it to. So it's a nice legacy.
Yeah, it's an interesting point you make, because about 7 or 8 years ago, when I bought this house and we found a financial advisor and didn't realize I could give charitable donations without having to take cash out of my pocket. It's you take a stock and you say, okay, I'm going to gift this stock, and the stock, the gift that you're giving is that stock price on the day that you transfer those assets. And many charitable organizations are, they're 501c3 organizations, and they can take that stock, sell it, and you don't have to take cash out of your pocket. So it's not affecting your cash flow at all. Let's say you have a good year in the market. You say, okay, I'm going to give these people a couple shares of NVIDIA and call it a day. So that's a great point, and something I wish I had learned a long time ago, but it's learned nonetheless. When should someone start planning for this stuff? I know that you talk about best practices, and I actually have already started. I had my meeting with my accountant. We went over a whole bunch of things, and he said, okay, here's what you have to do towards year end. When does should someone start doing that, and how do they go about doing it?
Yeah, just coming back to the charity, if you're gifting a stock or Bitcoin or anything else, some of these custodians have deadlines. So I'm saying probably now until first week of December. If you start pushing it past then, you may or may not get it done, because you're transferring an asset. So that's probably the right guidance.
Right. And when you're talking about planning in general, what are best practices for starting that, gathering all your information, stuff like that?
You want to address that, Brandy?
Yeah. Ideally, I would say it's an ongoing process. There's different planning objectives throughout the entire year. So now that we're 2 years in, I have a lot of new clients being onboarded right now that we're gathering a lot of information where this will be their toughest year for end of year planning. But as of January 1st, we're going to be in touch every quarter about any new things that are happening, any business sales, any big bonuses that they've had. And we'll already be prepared for this crunch time and how to strategize on what we want to put into place. So I would say ideally all year long.
So let's get into gifting a little bit. We talked a little bit about that, not taking cash out of your pocket, giving, appreciated stock. What about, you talked about family gifting, Brett? How does that work? And how do you get a tax deduction for giving a family member money?
Yeah, it's a great question. So first of all, it's understanding what the general rules are. So you can't just give another person unlimited amounts of money, right? If I give you $1 billion, you couldn't just hand me $100 million because there's a set of rules in the US called gift tax during lifetime, or death tax, as some people think about it, estate tax at death. And it's a very specific set of rules. So one way you can do gifting during lifetime is you're allowed to gift up to $18,000 per recipient. So for example, a family with 2 children, a husband and wife could each give $18,000 per kid. That's $36,000 a year. So that's a great way to start gifting along the way. It's incremental, and depending on wealth levels, it could be a high number, but for other people, it's something that makes sense to do early. And that's the amount you're allowed to transfer without any gift tax. Now, there's a separate side of the law, referred to as, most people think of it as, the death tax, and that is you have next year almost $14 million per person that can get gifted to the next generation, either during your lifetime or at death. And so for wealthier families, doing that annual exclusion gifting that I first mentioned is a way to do gifting above and beyond the $14 million per person. For the $14 million a person, that is something that has more of a magnitude if done today than in the future, because it's just, it's a calculation of present value of money. So if you have the means and are looking to get assets out of your estate, because again, if you were an individual with more than 14 million and you were to die, anything above that amount, you're going to pay a tax on, a death tax that might be 40 or 50% of what's left. So there's a big incentive for wealthy families to plan over a multi-year period and get assets out of their taxable estate, and depending on their, ambitions, either get it in the hands of other family members or charities. But I think that framework of understanding the gift and estate tax rules is important. So most people should be thinking about gifting to children, and the gifting, of the estate at death type stuff is for bigger investors. But I will note that 14 million a person is based on a law that was put into place in 2018. And so that law goes through the end of next year and then so-called sunsets, which is it reverts back to the 2017 law if no act is made to extend it or change it. So if that were to happen, then the $14 million you can pass on during lifetime or at death becomes 7, gets cut in half. Now, something will probably happen between now and then, but for people with a taxable estate in excess of that, either, again, a 14 million per individual or 28 million for a family, they ought to be thinking about looking at gifting and perhaps doing something proactive, certainly by the end of next year.
Now, is that gift money, does that come off your adjusted gross income, the gifter? Does that come off their adjusted gross income?
Yeah, it's actually a different concept. The adjusted gross income and stuff all relates to income tax, paying tax on income. This is really avoiding death tax or estate tax, which is a different layer of taxation and one that really only wealthier families deal with. But nonetheless, it's a pretty punitive tax. As I mentioned earlier, it probably ends up taking 40 or 50% of what's left above these thresholds. And so, there's another side to this, Andrew, for, the wealthiest families. They might have businesses or private investments or things that they want to gift to the next generation that are hard to value, hard to figure out exactly what it's worth. And so they can oftentimes gift a lot more than the 28 million combined, by using more sophisticated planning techniques that we talk to clients about, but in conjunction with estate attorneys that might, gift more than 28 million, but only use up 28 million of exemption by making arguments that, well, you gifted an asset, but it's not that marketable. There's no market for other people willing to pay you for this because it's a private investment. So we don't really know what it's worth. And that would be lack of marketability. And then there's something called minority interest, which is simply if I gift you 1% of something, that's not as valuable as having a controlling stake in something. So by using some of these discounts, I'll call them, wealthier families are able to gift much more than 28 million. And let me just add, none of this should be construed as investment or legal advice. This is really just educational,
Right.
and you really need the right team of professionals around you that can, do the planning correctly, but also walk you through these complexities and make it as simple as possible.
Now, Brandy, I have a question about gifting to a 529. Now, a lot of people, look, when your kid is little, you're trying to save for college, save for education, and not only can a parent contribute to a 529, but grandparents, aunts, uncles, if they wanted to gift, they could do that as well as a deduction, couldn't they?
They can, right. And that is one of the areas, like Brett is talking about, that we can use different strategies for these families trying to avoid death tax. And one of these families can take $90,000 per grandkid and front load contributions to a 529. That would count as a 5-year front load, but $90,000 right away into a 529 can have a substantial amount of growth if you're giving that to a child that's in their 10 and under, or even as a teenager. That can make a huge impact for them. And then with a 529, being able to pass that on generationally at this point, the IRS allows you to move that on to your child or nephew or niece. It can really support families all around if you have the means to do it.
So 529, it was funny when I looked at a 529, I was like, okay, I'm going to put away enough money for my child to go to college. But now you can put a lot more money in there and just change the name on the 529 to a family member and continue that education fund.
That's right. And that means that no matter how much college tuition skyrockets, your money is growing tax-free as long as spent on educational funds for all of your family if it works out.
Wow. So and do you have to be a grandparent? Could it be aunts and uncles putting into that fund?
It can be. We even have godparents doing it that have no bloodline relation whatsoever. So anyone can open a 529 for a child and help it be funded. You can also fund your friend's 529 for their kiddo. It doesn't have to be blood lineage to fund these in any way.
So gifting, we've covered the tax angle. We've covered the gifting angle. Let's talk about the retirement angle for a minute. And it was interesting because on Wealthion's YouTube community page, I put up a poll because people are struggling in this economy, even though everybody says the economy is great. And I asked in that poll what people are skimping on, whether it be, are you waiting to buy a house or a car? Are you waiting to go on vacation? Or are you not contributing to your retirement fund because of the economy right now? And a good percentage said they're not contributing to the retirement fund. I know that makes you cringe, Brandy, because that's something that you do and counsel people on, extensively. So how important is maximizing retirement contributions, even in an economy that's a little tough?
Right. And it is one of our topics we put on here. However, our main goal for retirement is just a savings amount. What is it going to cost you in retirement to live a life that you're currently living or even better? So we can get there in a lot of different ways, and there's a lot of different routes. It doesn't have to be with retirement contributions. However, the end of year is just a deadline the IRS puts on these retirement accounts that we have to pay attention to. So by December 31st, all those people out there that have a 401k with their companies, they have to try to max that out if that's their saving strategy for the year. This year, $23,000 for 2024 is a substantial amount to save. However, if you really don't want to put it in a 401k because of your skepticism of the government or how taxes are going, whatever your reasoning, we can also put that in a savings brokerage account that is growing in very strategic ways, but isn't locked into a retirement plan. If people are skimping on this, it's okay to maybe give them other options like an IRA, for example. You can give to an traditional IRA or a Roth IRA. Those maximums are only $7,000 this year. So maybe it'll make your client feel like you're still saving. Maybe let's just lower that level to still attain our goal when you retire.
So how do you, what are some of the vehicles to that retirement? I know there's a 401k, there's a Roth, and we've discussed these prior, but let's go through them again and the contributions that you can make.
Right. So through almost every corporation or big company that employees work for, there's 401ks, there's 403bs, 457 plans. Some use Simple, some use SEPs. There's an array of different retirement savings options. Then on your own, you can open a traditional IRA or a Roth IRA. Then if you're an entrepreneur, you can open a solo 401k. You can do a SEP on your own. You can do a defined benefit plan. There's so many options out there that really you just need that team to advise you on what suits you best. Any which way, we believe that having an IRA, a traditional IRA, and a Roth IRA are really important to your core set of accounts. And that's because if you do have a good year and you want to save even to that $7,000 level, an IRA is a good avenue. If you're in a low income tax bracket and you can give to your Roth every year, you should give to that as well. And one area we also use with our high net worth clients is a backdoor Roth. And we love this strategy because it grows tax free. And with everyone a little bit worried about how much money's been printed and what could happen to our tax brackets, growing an account tax free is really preferable.
So Brandy, the backdoor Roth, just to clarify, is really for someone that's over the income threshold to make a traditional or a regular Roth IRA contribution, right? So it's a way to go, yeah.
So if you are a single individual making $161,000 or more, you're technically ineligible to directly fund your Roth. If you're married filing jointly, that number is $240,000. Now, there's a little asterisk there that there is a little bit of a pro rata for certain income levels, but those are the maximums that really cut you off. So if we're dealing with those income levels, we offer to open an empty IRA, fund it with that $7,000, and then we call our custodian and say, we want to convert that to a Roth. And in doing so, you go on your tax form and you make sure you titled it as a non-deferred contribution to your IRA. So you checked all the boxes, followed all the rules, but then we get to transfer it over to the Roth with absolutely no tax implication.
So you can actually put things, you move a traditional IRA to a Roth IRA with no tax implication. Now, the Roth IRA is post-tax. When you fund that, it's post-tax. Your traditional IRA or 401k is pre-tax. So when you convert it, you have to do it very carefully, I would assume, to avoid that tax.
Correct.
Yeah. I think in the example Brandy was going through, you do that by doing non-deductible contributions into an IRA, which is different than a normal IRA contribution. So normally it's pre-tax money, but if you do a non-deductible or non-pre-tax money, then you are able to convert to the Roth without a tax hit at the conversion. But the Roth IRA, Andrew, is probably one of the most powerful vehicles that we believe in because IRAs are great, but at some point you're taking the money out on the back end in an uncertain future and uncertain tax rates. The Roth IRA, unless they change something, you don't get the tax benefit up front, but that money is forever tax-free during your lifetime, even when you take it out. So it's a very powerful vehicle. And, we even see, and this is back to year-end planning, we even see opportunities where wealthy very wealthy clients, you would think there wouldn't be an opportunity to convert from an IRA to a Roth, but there is. But normally that's only diagnosed by working with a CPA and actually doing like a kind of a year-end projection before the year is over. And sometimes a client will walk away and say, well, I don't owe any tax, nothing to do here. But I tell you, in practice, we've seen a number of times where we've been able to identify a fact pattern. Like, for example, we had a client that said, yeah, I don't owe any tax. And we looked closer and they actually had a net operating loss from a business that was going to carry forward for a number of years, but they were now retired, so they didn't have income. So their accountant was like, well, you just don't owe tax. We looked at it and they had large IRA accounts and we said, you can convert those to Roth IRAs, use up the net operating loss, and basically end up with everything in the Roth IRA. We've also had people that are retired that, again, are high net worth, so you normally wouldn't think they'd be in low enough brackets, but every now and again, they'll have a year where maybe their income's from municipal bonds, so that's tax-free and you're not pushing yourself up in the tax brackets. And maybe you have either capital losses in a given year, or maybe you're a private real estate investor and you have depreciation on assets that's kind of wiping out all appreciation and income and other gains. And you find yourself in a situation where you either have negative income or maybe you're in the lowest brackets. And so there might be a rationale to say, hey, why don't we convert enough from a regular IRA to a Roth IRA to just work you up through the lowest tax brackets, pay a little bit of tax, but tactically do it so we end up with a lot more in the Roth over time. And, if you want to take this, excuse me, one step further, the biggest power in the Roth IRA is, the younger you are, the more powerful the compounding in a tax-free environment. So we also have a number of clients saying, hey, how can I give my kids a leg up in a very difficult world of saving money and wealth over time? And one way is by helping them contribute to Roth IRAs. The big catch on it, though, is a child needs earned income. But maybe they're working, they're 14, 15, working a job. They can, and maybe they need that money for spending money, but you, the parent, can take that amount of money. Let's say they made $4,000. Maybe they use that for spending money, but you can take that money on the side, $4,000, and now open a Roth in their name and put $4,000 away. And for clients with businesses, which, is a large segment of our client base, you have the ability to employ a child, put them on the payroll, pay them enough doing various tasks to justify, an amount that will get them a full contribution to a Roth IRA every year. So if you can start doing that when a child's in their teenage years, you can only imagine by the time they're 30, how much wealth might accumulate, with that type of strategy.
So I want to ask you this question because, I told you about the survey I did. What do you say to the person who comes to you and say, you know what, it was a tough year, cash flow is, I'm a little strapped, I'm not going to contribute this year. How do you counsel them? What do you say to them and say, look, you know what, I understand this is really important?
So I've had a couple of those situations this year end actually, and we're taking a large step back from when we onboarded them and said, let's review your budget again. And let's just go through the areas that we maybe need to talk about sacrificing and pinching pennies on to make sure we're hitting that 5% savings goal. When once upon a time they were trying to save 20%, making it a priority to at least hit 5% of your income each year is vitally important to your retirement. So we take a big step back and really try to pinch pennies in area and re-educate our clients. And it's really important because every year your client is going through different aspects of life, different phases.
Yeah. The other thing I'd add, Andrew, is it's creating good habits. For example, I saw an article I shared with my daughter who's a teenager, which is, hey, instead of spending X amount of dollars a day at Starbucks, had you spent that $8 and just slowly invested in Starbucks stock, in 10 years, you have like $500,000 versus zero. It's that same concept. If you put a little bit in cryptocurrencies or a little bit in, some of these other areas that might have growth potential, even small amounts of savings compound and add up over time. So I think it's as much about creating a habit when people are younger. And as they get older, like Brandy said, it's reining in on a budget and having priorities. And listen, we understand it's a tough world out there. And for a lot of people, this is more of a luxury, some of these topics, but that is how you grow and compound wealth over time.
But I want to reiterate something you said. It's all about planning. So if you've planned, if from the beginning of the year to now, it shouldn't be a surprise, and struggling a little bit shouldn't take its toll on contributing to your IRA or your plan, because you've sort of, not that you can plan for a huge downturn, but you plan for certain things like this. You plan for, maybe struggling a little bit more than you had, depending on person's jobs. You have to evaluate all of that. So planning is of the utmost importance.
Yeah, let me add one other thought if I could, and that's almost the opposite of what we said. I have seen situations where people have put too much into all their IRAs and 401ks, and they're left with very little taxable money or like rainy day funds, where they feel like, okay, it's all in these long-term savings vehicles, but I really don't have the money I want to make the car purchase or put the down payment on the home. So, as Brandy was alluding to earlier, there is a balancing that has to be done strategically between not only Roth IRAs and IRAs, but also tax-deferred long-term investments versus taxable money that you can get your hands on in either an emergency or, for more of a long-term purchase like a home.
And Roth IRA is the vehicle to do a lot of those things. And, after watching some of our videos, both my sons actually opened Roth IRAs and have back funded it. One son funded his 2023 and 2024, and he's looking to, fund his 2025. So, and they're in their early 20s. So, $500 a month or the maximum $7,000 or something like that a year, at their age, compounded, by the time they get to retirement age, it's going to be well over $1 million. So it's not a ton of money to put away, but it can pay extreme dividends on the back end. So it's great advice. What else are we looking at benefits wise? I know there's HSAs and flexible spending, stuff like that. What else can we put our money into to save on taxes and what we might owe the government?
Right. And these areas go back to planning, where I would say annually, whenever people have open enrollment time with their companies, it's a really good idea to reevaluate these topics. Then you have companies that don't have any benefits, and there's still areas to review and make sure you're maximizing. You brought up HSA and FSAs. Those limits and statutory amounts go up every year with the IRS, and they let you put away money, depending on the type of account, tax deferred, and it doesn't come up on your income. You can then use them for dependent care, health costs. It all depends on how the plan is written. If you have a certain health savings account, those can be a triple tax savings because you put it in tax-free, you actually grow it tax-free, and then you get to pull it out for any health-related needs tax-free as well. So it's a major benefit if you have that under your company to maximize that to the fullest. FSA is a little bit different. Like I talked about dependent care. A lot of parents don't know about this, but you get $5,000 a year of your income to put in there. And up to the age of 13 for your child, you can pull it out for free as long as it's used for anything dependent care eligible, which could be summer camps or summer sports. It could also be private tuition. There's a variety of ways you can write that off, and it's really beneficial to do that up to the point you don't think you could spend the $5,000.
So some of this money can actually go to pay medical bills as well.
Correct. Yes.
Which are not
So
cheap.
your dentist appointments, your annual checkups, things like that. And even clients that say, we're a really healthy family, I don't think that's necessary. I can map out the fact that if you do your HSA account every year and get all of these tax savings, it's much cheaper than long-term disability care. Those are very expensive policies to get. Usually people get them too late in life. And really, they're so unpredictable if you actually get the benefit of that insurance or not. So this is the safest and most efficient route to not only use right now for health benefits, but later down the line.
I think this is something that people don't know a ton about, but Help educate me a little bit on the HSA. How does that grow? You're putting money into a fund. How does that grow, and what do you use that money for?
So most of the time, these HSAs are through your corporation. So just like your 401k, if you look into it at your corporation, they give you certain risk tolerance levels to pick what your investments are. An HSA is a little bit more restrictive, but it's still the company's selection. You usually, I would say 95% of the time, cannot touch those investments because it is their fiduciary responsibility to grow it at a very low risk level. So it won't grow substantially like the Bitcoin investments that Brett talks about, but it will be that effective compounded interest over time in a very safe manner.
And what do you use that money for as opposed to a flexible spending account?
So, like I said before, it's an array of options. You can do it for dentists, annual checkups. There's even some, there's on Amazon, you can go on and you can look up what is HSA approved and start to spend your money on that type of stuff. So, some toothpastes are eligible, some foot massage equipments. Like I've seen the craziest things come across my desk that you can use it for. So if it's a use it or lose it type strategy, which some of these accounts are, where well, you put $1,000 in, if you don't take that out, the government just takes it. That's how some of these are written too. And that's where I advise my clients, go on to Amazon, click on the eligibility, FSA eligibility and HSA, and spend that money on things you need or could use as Christmas presents. Who knows?
What about insurance policies? Where does that fit into this? A lot of people, obviously an insurance policy, a regular insurance policy you have until the age of 70 something, but then there's whole life. Is that a way to save?
It can be. It all depends on the situation. So the last firm I was with used insurance very strategically for an investment vehicle. And so if my clients are inclined to do that, we can educate them on that versus other means of savings. But in everyone's life, I would say life insurance, it is crucial if you have any debt or if you have family members that you care for to be financially stable if anything unfortunate were to happen to you. So it all depends on the client again. Some people use a term life policy just till their kids are out of college and then they're done with life insurance. Some people use index universal life and policies, similar to a whole life policy, where there's a cash value on it. And those can be relatable to a Roth IRA, where the cash accumulation in it grows tax-free and you can withdraw from that cash. And I always advise if clients have this policy to wait until retirement age, because that's when it's going to be most beneficial. The downside of that is that insurance is very expensive. You're paying for a company to take the risk on whether you're going to pass away or not. And so the commissions that insurance agents get off that and the insurance policy gets off that is front loaded usually. And so the first couple years you're paying into the policy, you're not really seeing any cash value. So that's why waiting on those policies till you're 65 is really important.
So planning is the most important thing. And if you were to speak to a client and say, hey, look, this is where we start, this is where we'll end, what is the basic message, the most important message you're giving to somebody?
Right. Well, first, I would say there is no end because it's perpetual and ongoing no matter what phase of life you're in. And even if you are at the end of that timeline, you're talking about your inheritance. You're talking about your grandkids and your kids. So planning is a continual, perpetual effort that you really need the right team and someone you trust to talk to that you know has a plan in place and will constantly be your advocate of what you need during those phases of life.
Has anybody come to you a complete disaster and you've put them back together and said, okay, you know what? We're going to plan this and you're going to be okay?
Yeah, I think it's typical, Andrew. I mean, oftentimes people are busy in their own life, especially if they're working or running a business. And that's why it does come back to having a key group of advisors. I know we keep saying it, but I saw the other day, there's something like, I don't know, something 1 million pages of IRS tax code. And so, the client can't figure that out. We can't figure that out. You need someone that's doing that every day to figure it out. Same thing on the legal side, same thing on the investment side. And so you need the right team. But I will say, just in practice, what oftentimes happens is clients, they like working with their CPAs, but CPAs are always busy and they're just hard to lock down. You can always get a hold of the attorneys, but the attorneys are expensive and clients oftentimes know every time they talk to them, they're paying. So an investment advisor normally sits in the middle and has a pretty good vantage point on general planning topics. But we're not the tax experts. We're not the estate experts. We identify potential planning things, then bring the right people into the mix. And I think for anybody starting out, the other message is get a trusted group around you that has the right incentives, your best interest at heart. And if you can get that team, they're going to be the ones coming to you proactively suggesting things, as opposed to you feeling like we're talking about this paralysis going into Thanksgiving, like I haven't thought about anything. What do I do? Right.
Yeah. So I know that, late March into April 15th is the Super Bowl for accountants. This is kind of like you guys' Super Bowl time. This is when you're taking your clients and making sure that the planning you've done all year long actually comes to fruition, right? You say there's no end, but this is the end of this year's planning.
Correct. Yeah. And it definitely is busier right now. We're going through our checklist. We're making sure clients are on top of it. So it's a busy time, but in the end, I think it just gets easier each year we work with clients. And going back to your disaster client example, from our angle and how long we've done this, the clients that come in and think their financial portfolios are all intact and great usually are still a disaster. So I think most people aren't getting enough planning at all. And even if they have a couple of things they're doing on their own, they're missing so many pieces. And so it's really important to get an advisor as early as possible to start the conversation. I have plenty of clients that aren't technically even on our book right now, but I talk to them and advise them for situations that come up just to make sure when they are clients and they're eligible to be at our marker, our minimum, that we're ready to go and it's not a huge process.
So it's windrockwealth.com. If you go there, they can find the article that you guys have put together, sort of outlining all of this, right?
Correct. And more.
Yeah, and a lot more. But that's exactly where to find it. windrockwealth.com. Go there. You can find Brett and Brandy, and they can, you can read the article. If you need more help, you can go to Wealthion.com and find them through us. And, we'll get you all on the right road to financial success. Guys, thanks so much for joining me. This was informative and important. And I think a lot of people will now be like, I need to plan. And that's a good thing.
Thank you, Andrew.
Good. Thank you, Andrew.
Thanks so much for watching our discussion here on Wealthion with Brett and Brandy. They provided valuable information on how to protect yourself and your wealth heading into the end of the year. If you're looking to protect your wealth or in need of being financially resilient, please head over to wealthion.com/free for a free, no obligation financial review. And of course, if you could like and subscribe to the channel, we'd greatly appreciate it. Don't forget to hit the notification bell so you know when we post new videos on the channel. And please do the social media thing with us. All the links are below in the description. And if you like this content and are looking for more ways to achieve long-term wealth, watch this video next. Thanks again for watching. Until next time, stay informed, be empowered, and may your investments flourish.